Good afternoon, everybody. Dennis Mattern with CreativeOne. So happy that you have taken time out of your busy day. I'm going to slide my microphone a little closer, make sure everyone can hear me loud and clear. But I'm so excited that you're here with us. And as you can see, we've been playing around with the cameras and such. You get to see the smiling faces behind the numbers. Kevin gave a thumbs up. He's not on camera yet. But I wanted to, first off, thank you for joining us today. We are going to talk about we're going to talk about the index performance review. This is where we go through our index performance report. We take a look at the actual performance of the indices. And one thing that's different on the report, we've got a lot of information. During this webinar, we actually name names and put performance to performance.
It's all out there. There's no hiding from the numbers, Dennis.
Now, joining me today, I'm going to flip the camera over to you, sir, Kevin. This is Kevin Cloud. He is our Chief Actuary here at CreativeOne. Kevin, as always, welcome.
Thrilled to be here. Scared for our audience who has to see both the presentation and our faces, but hopefully they'll survive both those things.
I think it'll add some energy, some pep, if you will. One thing we are going to do, I'm going to switch the camera back to me. One thing, just a couple side notes. If you look at the bottom right corner of your screen, you'll see a little blue box, and it's a chat box. And if you click on that, I'm monitoring it. So if you have a question that you would like to ask, if it fits the flow of the conversation, we'll answer it right then. If not, what we'll do, we'll save it to the end and we'll run through it. Also, I've got a couple questions for you this time. I've been curious, so I pre-built some poll questions. So I want to know what you have to think about different things. Couple last things. This is recorded, so we'll get a copy out to you so you can fact check us. And then two, I will get a copy of the report. The report is going through final edit. The report I'll get as soon as I get a copy, boom, it goes out to you. So with that being said, Kevin, are you ready to get started?
I'm ready. Thrilled our audience is going to have some opportunity for participation. I'm tired of carrying this thing, so let's get some other people pulled in, see what other people think.
I love it. Okay, so one of the things that I do want to point out, so this is a shot of the report itself. And one of the things that Kevin and the design team have done that is amazing is on the left side, and actually since the camera is up over that way, I'm pointing the wrong way, you'll see the name of the index. And when you get the report, if you click on it, that'll take you hyperlink landing page so you can look at the performance. You can really dig in. The next column, super important, is you can find an index that you're interested in, but then who has that thing? So we've got the name of the carrier. There's another line, it's another column, it's a checkbox, and that means that it's actively available. And you might be noticing, hey, there's a couple that I don't see a checkbox. That's because those were such big indices, so commonly used, that they're still renewing, not currently available going forward, but on existing policies, you need to know what's going on there. You can see the performance, 1 month, 3, 12, 24, 5, 10 years. And then this is, I think, a little bit of secret sauce here. I think this is awesome. Kevin and the development team put this on here, but you can actually see if you're interested in a key constituent, maybe you're looking for bonds, maybe you're looking for an index that has international equity. You have the ability to look at that checkbox and you can find it very quickly to highlight what you're looking at. All the way to the right, the volatility measure, how high, what are the swings going to be? So Kevin, I'm going to turn the camera to you for a second. Comment on your beautiful report that you have.
I think my comment is more of a question. So one thing we historically did for this report and its prior iterations is to delete indices that were no longer available. We kind of decided to change that because there were so many indices that you mentioned that were very popular or prevalent. So we started leaving them on there. But there's a few old indices that have been deleted over time that I thought about reintroducing. So I'm curious if any of our audience is interested in some of those older indices that are no longer available, maybe haven't been for a few years, but are still kind of out there. Throw me your thoughts if you have them. And if you don't, that's fine too, but something that I've thought about. Do I want to re-add some of those older indices?
Example.
Boy, now you're putting me on the spot. Almost every carrier has an index they've deleted that I've deleted from this report over time. So what's the one I'm thinking of? I don't know. I'll come up with a list. We'll come back next month. I'll get a list of everything we've deleted, things we could put back in, and see what our audience thinks.
All right. So we're going to go, here's our agenda. We're going to talk index performance. We're going to go to strategy performance, real world, and then we're going to talk analysis. So we're going to get into that. Before, though, I'm curious, we've had anecdotal conversations about this. So I have a poll question for everybody. Be honest, and you can totally be honest because it's anonymous. No one's going to see your results. But I'm really curious where you stand on vol control indices. Here's your categories. Where do you fall? Where do you fall here? You used to be a fan. You're slowly becoming a fan. You're skeptical. You've never been a fan, or you know what? You're a huge fan. Take 2 seconds. Humor me. Tell me where you fall in that category. I am so curious about that.
Yeah, tell us what you think, but also, hey, those are, 5 discrete answers. If you have some context you want to put in the chat, we would love to hear it.
No, don't put it in the chat.
I'm sorry.
If you, by the way, so if you put it in the chat, everybody in the audience sees it. If you put it in Q&A, I'll be your proxy. I'll read it. So here's where things are falling, Kevin. Tell me if this surprises you. I got 25% used to be a fan. I got 25% slowly becoming a fan, and it's going. It's the numbers are moving quickly, but skeptical so far is number one. As answers are coming in, it's skewing the percentages, but skeptical and slowly. So I think that's fair.
Interesting. That's very fair.
I think that's very fair. Most people are skeptical. And you know what? You should be.
It tells me that our audience is nuanced and critical thinkers and paying attention, which is exactly what we want and exactly why we're here.
I like it. Okay, so that begs the question. Humor me one more before we get in there. With that being said, are you putting anybody's money in vol control?
Ooh, money where your mouth is. Let's find out.
Proof is in the pudding. And is it pudding or pudding? I don't remember.
I think it depends what part of the country you're from.
I like it. Okay, so one more quick question, and then we'll quit goofing around here and we'll get into the actual returns. But are you using them? Oh, so Kevin, interesting. This is, as they come in, the percentages will change, but right at the moment it's 50-50.
Wow, I feel like we're watching the news on presidential election night. We've got returns coming in live as we speak.
Oh, as we speak, we've got some people to either convert or like totally justify their worldview, because it did just skew. It's 67% no at the current moment. So,
interesting.
Very interesting.
I would love to know if you feel like typing in the Q&A, if that's because you've always been skeptical or because you've gotten some bad returns and you don't want to be subjected to those again. Again, anything that we can learn would be super fun for us and for this webinar.
And make it even better. Okay, so let's hop in there. So one of the things with the report, there's going to be a lot of numbers that are going to pop up. And for a hot second here, much to the disappointment of my mom who's watching this, I'm going to turn our cameras off just for a second.
Tough blow for our audience, for sure.
It is tough. But what this will do is you're looking at one of the pages from the report, not from the report. This is exclusive to the webinar.
Correct. Webinar only.
Webinar only. But what you're looking at is the index strategy returns. And I'm going to set the table. Kevin's going to do cleanup here. But what we do is we look at the 12 months prior. See, these are all 1-year resets, 12 months prior. So close of business October 31st. And then we go into each individual. What you see on the chart here is you see the name of the index. You see the change of the gross indices. So that top left one, the gross indice, it changed 1.54%. So where is that? What were the factors? So then we go to the strategy. Was it available with a par? Was it available with a cap or a trigger? And then you look at the actual factor percentage rate. So in this case, that top left, it was available participation rate with 138% participation, which means that it credited 2.26%. Now, what I always like to do, Kevin, I always like to look around, and we do know also we don't carry the math all the way out. So if the indices gross return is negative, there's no point in figuring the math out because 0 is your hero.
True.
So when I look up here for the close of 12 months closing at the end of October, it looks to me just eyeball test. I'm going to go like 80% positive returns.
Interesting. You've been doing this for a few months now. So this time I actually proactively looked at the percentage of indices that were positive. The actual number, 74%. So not bad at all.
Okay, so when we're looking at this, should I jump to the next slide or do you have any commentary here?
No specific commentary. I think just anecdotally what you'll see is a lot more indices are in the positive category than they have been over the last few months. And there's a few reasons for that. But two of the big reasons are we continue to be in a very equity positive environment. Other reason is there's still a fair amount of bond allocation to a lot of these indices, and interest rates have been going down. Interest rates go down, bonds go up. And so I think that's been driving some performance and pushing some of these indices just over the edge from negative to positive, which can make a big difference because you can see a few of these have some pretty substantial participation rates. So the difference between, 1% negative and 2% positive with a 250% participation rate, a 5% index credit. So it can make a huge difference. It really does matter. And you can see some examples. So look at the Barclays Atlas 5, 6.04% change, but you have that massive 220% participation rate. Suddenly you're in a very positive credit position.
And if you're looking, it's on the top left, maybe at about, if I was doing
six down,
or I was going to say 11 o'clock, maybe 10:30 in the morning up there, up in that neighborhood. So up there on the left. But it's always interesting to me too, and this is a discussion, absolutely have this discussion with somebody on the sales teams here, because they'll really dive in on that. And that is, so for example, the S&P 500, are you a person that likes cap or are you a person that likes par? Which way do you want to go? Because if you look on the chart there, you can see the difference between the two, or trigger. Those are conversations that our sales teams all are interested in having. Let's go to the next. So Kevin, you always break this down by, you have a couple that we want to highlight. So
right. Well, just looking at what strategies and indices provided the biggest credits. I want to know. I assume our audience wants to know. So we've put it in a form. And it also allows us to do a month-over-month comparison on some of the bigger crediting strategies, kind of see anecdotally again how much strategies are crediting, what the magnitudes are. So we see quite a few of these that we've seen historically. A few have popped up, a few have come off. We talk about the S&P Mark V quite a bit. That has a gold component that's really been positive for it. Yeah. We're going to talk some more in just a minute about the BNP Paribas MAD 5 index, which popped up here in a really interesting way. You see the City Area Index, which had a really good credit. That's closely tied to, there has a lot of exposure to NASDAQ indices and individual stocks. So that's up there. We see some interesting, we see technology and the S&P 500 Raven Pack AI pop up there at the bottom, some tech and AI indices starting to get some play. But overall, I think what we generally see is some trends towards more positive credits than we have seen for the last few months. Ever since Liberation Day, quote unquote, we've seen some pretty depressed credits. I think we're starting to work our way out of that, and a lot of indices and a lot of strategies are crediting in a very positive way.
All right, I'm going to take, you were on camera that whole time. I didn't even tell you. Okay, so one thing I do want to say, and so we're going to pop up here now last month.
Yeah, let's see where we were last month.
But before we do, one thing I do want to say is I don't want anyone to get the impression that we're like chasing returns or something like that. You know what I mean? Like we're looking for yesterday's hero, because the thing you always say in the security world is like past performance is no indication of future results. But by studying the past, we have the ability to take a look and understand the conditions that cause different results, different returns, so that we can make better decisions.
Absolutely. And also allows us to examine things on a grand basis, so we can see how indices are performing, broadly speaking, not looking necessarily for individual performers. But go ahead.
I'm going to take the camera off so that everybody can see easily. But so the left side, I'll set the table. Left side is current month.
Correct.
Return ending
10/31.
Yep. And then the right side is the end of last month.
Correct.
What do we see?
I think what we generally see is credits that are substantially higher, to the tune of 4 to 6%. There's a lot of reasons for that. Some of them we just mentioned, but generally what we're seeing, and I hope you're seeing for your clients, is these indices and their strategies starting to kind of shake out of that downturn they had with, like I said, Liberation Day and some other issues. One of the big problems, we discussed it before, I'm not going to get into it a lot now, but there was kind of some slow recovery from Liberation Day. Even though the equity markets recovered quickly, when you have elevated periods of volatility, you don't necessarily get that exposure, and so some of these indices can lag. Well, I think the lag is starting to work its way out, and so we're seeing some better credits. And I hope what we're showing here is also being realized by your clients. I would love to hear if you have any anecdotal thoughts and want to add the information.
Absolutely. Quick note, again, bottom right corner, you have your chat box. If you want to say anything or want to ask a question, feel free. If you type it in the chat, everyone sees it. If you put it in Q&A, only I see it. I'll be your proxy. Also, we are recording, so you get a copy of this. And then also, you will get a copy of the full report so that you can work your way through that. I'm saying that for the benefit of the people that just joined. Thanks for being here. Okay, we're going to keep going. Okay, so let's look. So this is interesting. So what do we got here? This is always fun.
So naturally, what's most important when we do this examination is, the 12-month and in a minute, the 24-month crediting periods, because that's that's what actually results in your client getting something. And what happens in between is important, but can also reverse or be changed, or who knows. But we want to examine how these things are doing on an intra basis. So let's see how they're doing in the middle. And what we've really seen is some very positive performance. We talked about how, again, these indices were somewhat slow to recover. They didn't necessarily grab onto the recovery after Liberation Day, even though overall equity markets did. Created some problems, for lack of a better term.
I'm going to pause you.
Yes.
If this is your first time watching this recording, or if you forgot what Kevin was talking about, what Kevin talked about when you went through the reason why vol controls don't respond in recoveries, in quick recoveries, we did that like 2 months ago.
Yes.
That is, honestly, I don't mean to make you feel too good here, but that was brilliant. And that literally, if you're looking at vol control indices, we should actually cut that piece out and share that, because that was big.
I think that a lot of the banks have published pieces as well since then to explain what's going on. I think the good news is what we'll see is some future indices try to find ways to correct for that, for lack of a better term. But anyway,
that is pretty tough though. When you've got a vol control, the S&P takes off, and you see the market spike and recovery, and you're wondering why the heck the vol control isn't. You explained it, but keep going. Sorry.
Yeah. So we want to know what's going on, beside just the 12-month period. Let's see what's going on in the middle. And so we have our 1 month or 3 month changes. Some hugely positive performance for vol control indices in the last 1 month and the last 3 months. So even they didn't necessarily capture that recovery, they are capturing some upside since then as volatility has come down, and to the tune of some very positive performance. So 1 month change in vol control indices, we see quite a few indices are actually outperforming the S&P 500, and that's for a number of reasons. Some of the reasons might be because they have at least a partial reflection of some NASDAQ stocks or indices, but still very positive performance. And remember, this is raw performance. There's no participation rates, but when you think about some of these indices, they have some pretty substantial participation rates. So what you're seeing here is a very positive performance. If some of these indices ultimately have 200% participation, let's say, then a 3.5 1 month change, it actually equates to a 7% 1 month change in your credit. So a hugely important thing to consider. And then again, over a 3 month period, we see some indices that are performing very closely to the S&P 500, which is super encouraging as we continue to do this for the rest of the year and beyond, Dennis. So hopefully what we see are some really positive credits.
Nice. Okay, so you had mentioned, you teased a little bit that we were going to look at the
BNP Paribas.
Some of the names are almost like purebred dogs or racehorses. But the BNP Paribas MAD 5. And so, Kevin, what are we looking at here?
So this is an index that popped up on the radar, and this index has been around for a long time. It's generally been a very positive crediting index. The last few months, it suffered a little bit, like a lot of the vol control indices have, but still just one we've looked at a lot. What was super interesting is that it had basically had flat performance for a few months, and then suddenly it popped up as one of the better crediting strategies, and I wanted to know why. So we looked at it. So basically what I'm showing is last month, this index, and then of course the strategies that are attached to it, basically had a 0% credit. Okay. And then suddenly it pops up having a nearly 13% credit, and I want to know what's going on. So basically what happened was from 9/30 to 10/31 of 2024, the index was down about 1%. Okay. We effectively dropped that period when we went from one 12-month period to the next 12-month period. So when we're looking at 9/30, we move forward a 1 month period. So we get rid of that negative performance. And then on the other end, what the index performance over the last month, we've kind of tacked on to that new 12-month period. It was up quite a bit. So it was super interesting to me. We dropped a bad month, we added a great month, and that effectively was the entire performance of the index, or accounts for the entire performance of the index over the successive periods. We went from a 0% credit to a index that 0% performance and then 0% credit to an index with a 5%-ish credit and a 220% participation rate. And suddenly you've got a really good credit for your client. And it's just, it was such a stark change over a 1 month crediting period. I really felt compelled to look at it. And some of the reasons are the reasons we've talked about. So this index has exposure to, I think, 8 different sub indices, US, Eurozone, Japan, equities, and bonds. It also has exposure to gold and commodities. But in the last 30-ish days, what's really driven it has been a large exposure to US bonds, which of course, as interest rates have come down, those have come up. It also has a not insignificant exposure to US stocks, so that's made a difference as well. But it was just super interesting to me that this went from a very moderate performer over one 12-month period to the next 12-month period suddenly having one of the best credits.
Right.
So,
and you know what? That brings so what Kevin just said brings up a great point. If there ever is an indice that you would like us to peel the wrapper on, take a look at, dive into the weeds a little bit, let us know, because it's fun. It's fun to take a look at this kind of analysis and see what's going on.
absolutely. And there are a lot of indices out there, as I'm sure our audience knows. It can be tough for us to, decide what to look at. It really helps if our audience can, give us some direction. And we'll gladly look at just about whatever you would like us to look at.
Absolutely. Okay, so before we go on to this next part, now we're going to switch gears and we're going to talk about 2-year resets. And so we've had this conversation, Kevin and I, on camera, off camera, in the
ad
studio,
nauseum.
I am so curious. I would like to know, are you using currently 2-year reset strategies? So I have my take. Again, this is anonymous. I think I pushed that out to the audience. I did not. Oh, there it went. It's out there. It's out there. So here's what I'm curious. Are you currently using 2-year reset strategies? Yes, no, or you used to? Because my take is we've had 2-year strategies. Some folks got kind of beaten up.
Yes, absolutely.
And people just said, "Hey, I'm not doing it anymore." My theory on the early election results, Kevin, early results coming in, 67% of you. Well, now it's dropped, but the majority, it's like 57, 60% used to, and the rest say no. I have nobody saying yes yet. Fascinating. I believe that carriers are just going to move away from it because it's just too long. But that could just be recency bias.
It could be recency bias. The other thing to consider is that not all products or carriers offer 2-year strategies. And so if you find a product you like that doesn't happen to offer those, there's some bias. But it sounds like the overwhelming response is no.
The audience has roared. So I'm going to go ahead, and I had us on camera. I'm going to take us off camera. But what I want to show is we're going to take a look at the 2-year reset. So again, here's what you're looking at. Indice, change of the gross indice, the strategy, the factor, the credit. Wow, there's a couple big ones right off the bat. One thing I want you to remember, though, as you look at this, because I always like to remind myself and everyone, is that you're looking at gross returns of the 2-year period. This is not annualized. So Kevin, walk us through what we're looking at.
Well, I'll let you start, actually, Dennis. How many negatives or zeros do you see?
Oh, wow. 1. I see. So what is that?
There's actually 2.
Talk on it.
So we're in the low 90s.
Wait, I only see 1. Oh, I see it. So yeah. So the 90 percentile.
Yeah. So really, I mean, this is kind of a breath of fresh air because we've seen so many. We've done this webinar so many times and had the 2 years basically really sucking wind. Not the case right now. What we're seeing is actually some really credible performance out of 2-year strategies. Some of them are actually, so if you go back to actually one slide, maybe I'll start putting it on the slide. You see the S&P 500 par for the period. There was a 70%
right
participation rate that was available, credit of 44%. Awesome credit. If you got a 44% on your safe money, you did an awesome job for your clients. But we've actually had some vol control indices that have eclipsed that. In some cases by a fairly substantial amount. So super, super interesting. We're seeing really good credits at 2-year. We're going to talk about why that is in just a minute. Not all of these are super awesome performers, but I would say, and we've talked about this in the past, as the technology has improved and we saw new indices come to the products that we sell, we're finally seeing those get credit. So this happened, starting 3 years ago and 2 years ago. It's just taken a long time for some of these indices that are recently applied to products to finally yield credits. We're seeing that now. We're seeing some really, really good results. That's part of it. some other drivers we're going to talk about in a minute. But just some, I mean, at the end of the day, it's just really super fun, at least for me, to look and see credits that are, in the 50% range, even if it is over a 2-year period. That's awesome.
That is super impressive. All right, so let's talk about these returns then. Wow, look at that.
Yeah. So again, you see some of the same suspects here that we've looked at in the past. S&P 500 with their fast convergence, which is a daily, an intraday, I should say, rebalancing. We just talked about our friend, the BNP Paribas Mad 5. Mark 5 is on there, of course, with its gold. We see a couple of global or international indices in there. What's really fun for me is just seeing sometimes those huge participation rates. So again, look at the BNP Paribas Mad 5, 340% participation. That is, so let's think about that. Over the last month, we saw that the index itself was up about 3.5%. So basically 3.5% times 340% participation. That index added about 10-ish% of credit over the last month, which is absolutely wild and super cool. So if you were in that index or one of these others, then I hope your clients and you yourselves are very, very happy about the results you're getting.
All right, well, let's compare and contrast.
Again, kind of echoes what we saw on the 1-year reset strategies. We just see credits that are going up. So we see a lot of credits between, looks like about 5% across the board, 5 to 6%, where we're just seeing a lot higher. I think the reasons are super interesting. So we did this last month and we kind of predicted what would happen. And I'm glad to see for once my predictions turned out to be true. But let's hit the next slide, Dennis, and we'll kind of show you why that happened. So here are corporate bond yields and the S&P 500 since the beginning of 2023. So almost 3 years.
Okay. So corporate in blue, S&P in white.
Correct. And so where were we 2 years ago when these strategies were getting put on the books? And what you can see is S&P 500 was at a relative low point, certainly low compared to where we are now. And corporate bond yields were at their zenith. Now, not suggesting that insurance companies invest in corporate bonds or just in corporate bonds. They have very sophisticated asset strategies. We're really looking at this just for indicative levels. So, yields were high back then. That's what we're trying to say here. I don't want to imply that corporate bond yields is what they're doing. So yields were high. Equities, turns out, were very low. There was a lot of increase after the fact. And so we were in a perfect storm. We had, at that point, would have been probably just about the highest crediting rate inside fixed index annuities that we've seen over the last 15 years, I'd say.
Yep.
And in the subsequent 2-year period, we've seen a huge run up in equities. So basically what we had was really high crediting factors, which are based, of course, on the yields that insurance companies are able to earn. And we had equity markets that have taken off. And what's that led to? That has led to some really, really good crediting rates inside 2-year strategies. So 2 years ago was the perfect storm. What's interesting is that it looks to me like we'll continue to have some pretty good 2-year crediting rates. So you'll see corporate bonds are going to drop a little bit, and that's definitely going to hurt rates. And we'll see that as we go forward in time. But equity markets over the next 2-year period are going to be really, really good. And I think you'll see positive crediting performance. So it interests me if things like this actually change anyone's mind. I don't think I would ever go solely into a 2-year, crediting strategy only. But for a small portion of your client's allocation, is it worth it?
I think
maybe.
So.
I would say at least think about it.
All right, as we get ready to land this plane, interest rate spotlight. Kevin, can I refinance my mortgage?
It's interesting. I read an article that said mortgage rates were still holding pretty high. I don't follow them super, super closely. It sounds like you might be, so maybe you can tell us.
I also saw that somebody was floating the idea of a 50-year mortgage. What is that?
I don't know.
That's a topic for another day.
Wild stuff.
Yeah.
Anyway, we see yields continuing to decrease as the Fed's getting a lot of pressure, some of it political, some of it economic, to lower rates. They just did so. Although some of the language out of the Fed was that maybe they're going to take a pause after this. So you see kind of at the far right, look at the 10-year and the 2-year. They were down. Then they spike back up a little bit, which is kind of them predicting that, hey, maybe things aren't going to get a whole bunch lower as soon as we thought they might be. So look for rates. We've seen the 10-year, and it's hard to see on here. It actually got below 4%, but has bounced back up into the 410, 415 range here for the last few days. So we'll see where it goes. But generally, it looks like yields are decreasing. We've seen some compensation in credit risk spread. So, no insurance companies buying just treasuries or treasuries really at all. But they are, they're buying fixed income securities that have some kind of premium for risk. So we've seen those premiums come up a little bit, which is helping insurance products. I know you follow rates very, very closely, Dennis. We've seen rates come down, but I think it's been fairly muted based on what we're seeing in general interest rate terms.
It's if looking at carriers and such, it is always interesting because it's hard to interpret, because you not only do you have the economic factors, but then you also have to throw, and we're getting towards the end of the year and I don't know that carriers do this or not, and I'm not speaking on behalf of Creative, but it does seem like sometimes, goals are met, and so the faucet gets turned off or turned down just a little bit.
But it can go the opposite way as well.
It totally can. I did see a carrier. I did see somebody just raise rates,
yes,
which was a little bit of an outlier with everything else everyone else kind of dialing down and they're dialing out. But they're also a newer entrant to the market, so they're wanting to get a little attention. Which there you go.
More power to them. But yeah, end of year does tend to be very, very interesting in terms of interest rates and carrier strategies. However, Jan 1, 2026 is coming up real close, and we'll get a reset, and we'll see where we are.
Nice. Okay. With that being said, we are now at the end of the show. And so here's what I've got for you. One, we'll pause for a quick second. If you have any questions that you would like to ask either Kevin or myself about anything, type them into chat, put it in Q&A. If not, just remember this. One, we recorded today. We'll get a copy of the recording out to you. Two, we'll get a copy of the report out to you so you can see what's going on. And then three, we host this webinar unless something crazy happens. It is the second Tuesday of every month at 3 p.m. Central. We've been doing this for years, right?
Were we pre-COVID? Do you remember?
We're pretty
I think
close.
we were.
We're like right there. So, and then also, if there are any indices that you would like to for us to peel the onion back and take a look on the inside, what, why, and when, let me know. Just shoot me an email, dmattern@creativeone.com, and we'll do it. So, Kevin, no questions. So here's what we're going to do. On behalf of Kevin Cloud, my partner in crime and good friend, on behalf of CreativeOne, I thank you for taking time out of your day today, and we'll see you next time.